to our July Bold series. Today we're going to be listening to Sebastian Sanchez and Luke Nelson talk about business insurance. So before we introduce our speaker, we're going to introduce our Bold Speaker Series partner, Texas Security Bank. Today we have Melissa Varela coming in and talking about Texas Security Bank. But also a quick reminder to those who are here virtual, listening to us virtually, please submit your questions in the chat. That way we can transmit those over to the speaker and he will answer your questions. But Melissa.
Good morning, everyone. My name is Melissa Varela, and I'm with Texas Security Bank. Just a little bit of who we are and what we do. We're a commercial bank that focuses on owner-managed businesses. So, with a passion for continued education. Along with our Bold Speaker Series that we do here, we also have what's called the TSB Academy. The Academy is an executive business course that targets overall leadership development to give you the tools you need to grow your business. Along with that, we also have a blood drive today at our Garland location from 9:30 to 2:30 p.m. So if anybody is interested in attending, I have some flyers on the table. Now for our speakers. Sebastian Sanchez is a vice president in employee benefits at RHSB, an insurance consulting and brokerage firm that was founded here in Garland over 75 years ago. His healthcare industry experience, data-driven solutions approach, and account management background combined with his bilingual proficiency and multicultural understanding positions him as a strategic partner in an ever-changing healthcare system. Prior to joining RHSB, Sebastian led a team of benefit coordinators for the national broker area in Dallas. His background in account management provided him with an edge in understanding a client's needs and frustrations with healthcare system and management of employer-sponsored health plans. He is also a proud graduate of the Garland Leadership Class of 39, and he says that's the best class ever. Luke, and then we also have Luke Nelson. Luke Nelson is a vice president of RHSB, focusing in middle market commercial lines of insurance, primarily in construction, manufacturing, real estate, and retail sectors. By taking a comprehensive and strategic approach to insurance buying process, Luke is able to successfully deliver the best class results and service. Prior to insurance, he served in the United States Navy, Naval Special Warfare Division as a special boat team operator. Thank you for your service. Guys, the floor is yours.
Thank you, Melissa. One second here, I'm going to just pull up my notes. All right. Well, good morning, everybody, and to everybody on Zoom as well. The way of the present and future now is a hybrid model, right? So I'm happy to see some faces here in the room, and I know we have a good turnout of folks online. So I'm going to go ahead and jump into our presentation today. I know that you're all eagerly waiting to learn about insurance, so let's jump right in. But before you do, okay, make sure that you don't fall asleep while we're chatting. I know insurance won't be the most thrilling thing, but I promise that there's some stuff in here that's going to be interesting to really know, especially as you're an employer and you're dealing with all the different things, both on the employee benefit side and the commercial side that can happen. So along with that, we are going to have some questions that will be rewarded with some Starbucks gift cards for those of us that enjoy some coffee. So stay tuned for that, and I'm going to do the questions at the end of my portion. Then I'm going to hand off the mic to Luke, who will be talking about the commercial side. So to begin with, let me go back to my notes here. So important to note in 2020, if we were to just take a look back at what took place in 2020. In March of 2020, elective healthcare procedures were temporarily banned, right? And that ban didn't last very long, but it was a national ban, where while we took a moment to process what was happening in the country with the pandemic, everything was halted that was deemed, something that was elective, that wasn't absolutely necessary. Now, if we were to compare the GDP numbers from 2019 to 2020, because of that small pause that only happened from March to May, the GDP dropped 4.8% compared to what it was in 2019. Half of that was attributed to the elective healthcare procedures that were halted. So that's to give you an idea of how much money goes into elective or healthcare procedures, but especially some of the elective ones. The reduction in elective procedures caused $200 billion in financial expenses to hospitals and hospital systems and healthcare systems. Now, there's an issue with that word elective. When we think about that, we think of something that is optional, right? That you may or may not need to do, that it's doesn't change the outcome really if you do it or not. Well, that's not how it works with healthcare. A lot of things that are deemed elective are actually extremely important to people's health. Some of those things can be follow-ups or screenings that are necessary just to keep track of our health. And an example would be a colonoscopy for those that are in the age where you have to get that done, or that have had an issue in the past and need to continue keeping track of those things. Unless you are doing that, things can really get out of control. And that's exactly what happened in 2020. A lot of the elective procedures that didn't take place resulted in a spike in conditions like cancer that went untreated or were caught at a later stage, which obviously means a lot more risk to the person and a lot more expense to the health plan. So there was an uptick, as I mentioned, in untreated cancers, among many other things. Additionally, this is just to give you an idea of some of the things that got pushed back. There was an estimated 1.5 million spinal fusions and joint replacements that were postponed in 2020. 1.5 million. There was a backlog of 1.1 million to 1.6 million cataract procedures that were postponed in 2020. Okay? So what that did, and that once again, mind you, remember it was March to May that it was officially halted. After that, at least in Texas, we allowed for elective procedures to take place. But a lot of people didn't have the comfort level to go back, and they stayed and they waited, and they didn't get their procedure until much, much later. So this created a balloon in the healthcare system. So this slide here is going to show you an interesting information. It's an interesting graph here. So there was a 2-month halt in the system. It will take approximately 20 months. And this is 20 months considering that the hospital systems and the providers are working at 120% of what they were before. So overperforming to what they were before. It's going to take 20 months to make up for the 2 months that were halted. Now the 2 months, granted, as I mentioned, really it was longer than that because there were a lot of people that waited longer than 2 months to get this done. So there's definitely a backlog that we're going to see for the months and years to come. Now, what happened if you are a plan sponsor and employer and you have a health plan during 2020? Well, most of the carriers, and this is what this is going to show, and we call them the BUCAs, right? Blue Cross United, Cigna, Aetna. What did they do? Well, they were still getting premiums that you were paying, but they weren't necessarily paying out as many claims as they were used to before because everybody was home, not having their elective procedures done. So they held back and they passed what this graph shows. Most of them passed a fairly low, if not a flat renewal. So 0% renewal or very, very low renewal to just continue on and renew your plan, okay? During 2020, carriers were trying to just help out, and be conservative in their approach. So that was good for 2020. But what about now? The pandemic is at a much better place, although we're dealing with the Delta variants, but even that is much smaller numbers than what we were used to. A lot of companies are now back or transitioning back to office, and people have more comfort level to go and have their elective procedures done. This graph will show you that today, technically this is a couple of months back, so it's even higher today. We are pretty much at pre-pandemic utilization of the healthcare system. So people are now comfortable enough to go and have their knees scoped or have their pre-screening colonoscopy or all of those things that got halted. People are now back going to the doctor and to the surgical room. So there's a balloon that's been created, right? What is that balloon going to pop? Well, the answer is yes. There's no other way around it. Utilization is back to what it was pre-pandemic, and that's not even taking into account the fact that now there's a backlog of folks that are trying to get scheduled what they didn't get scheduled in 2020. So by providers, I mean health providers. So that's your hospitals, your doctors, your physicians, your care centers, all of those are trying to make up for what they lost during the time of 2020. The pandemic wasn't necessarily a moneymaker for any hospital system. They were having to do a lot of things that were required by the government, and they don't pay nearly as high as elective procedures would. So there's a lot of room to meet the gap there. As you guys remember earlier, there was a $200 billion loss for hospital systems. Insurance carriers, well, they must prepare for what's to come because they have this data much more granular than any of us because they're actually tracking the claims. So they're starting to see, okay, there was a lull in 2020, but now we're starting to see more and more people and then all the folks that didn't get things done. So what does that mean for our pocket as an insurance carrier? So they're starting to plan for that. So we are seeing that there is a trend that is moving in the wrong direction for employers because the utilization is getting higher and the cost is gonna show. So it comes down to three things, and I want to drive this message home. Really, if you remember anything, this is the thing that I think. So if you offer benefits through your company, there are three things that are taking place within that equation. Okay, there's utilization. That means how many of your people are going to the doctor and using the different options available to them with the hospital doctors, all of that. There's unit cost. Okay, how much does it cost for each one of these folks to go and have a knee scope or a colonoscopy? Many of the time we don't know what that cost is, but there's a cost attached to it. So the unit cost is important. How many people are going to use it is important. And then there's fixed costs, which obviously are going to be the administrative fees that take place with any insurance carrier to manage your plan. Got a nice little background music. So there are two areas that you can influence as an employer. Okay. Utilization and unit cost. And this can get a little bit in the weeds, and that's going to be a conversation for a different time. So offline, we can certainly get a little bit more granular when it comes to this. But as far as how you fund your claims for the year, right? If I'm a company of 100 employees, and I know that my spend is about $500 million, I'm sorry, 500. I can decide if I want to just pay an insurance carrier, Blue Cross, UHC, Cigna, Aetna. I want to pay them premiums, and then I don't want to look at it ever again. I want them to take care of administrating my plan. I want them to take care of paying my claims. I want them to take care of sending out all of the ID cards to my employees, everything. Prescription drugs, you do it. Blue Cross, you got it. I don't want to touch it, okay? That approach is called fully insured. You're giving the insurance carrier all of the control, and you're just paying them a set premium for usually a 12-month rotation. There's other ways that you can do that. That unfortunately is by far the most expensive way to pay for claims. The smaller the company is, the more that is a necessity, just because it can be a little bit cumbersome to manage all of your claims if you decide to do that in-house. Now, not only because of the pandemic, for years now, it's been moving further and further down market, and I mean in size. So before, a company that was 100 lives would always usually be, and I know I said always usually, but most of the time would be fully insured. So giving the carrier all the control. Now we're seeing more and more companies that are saying, you know what? There's a lot of money here that is falling through the cracks, and I would like some of that to come back to my company. How can I do that? And so there's ways to fund your own claims. Maybe you still pay for administrative fees, so the insurance carrier is still paying out the claims to the providers. It's still sending out insurance cards to your employees and managing with any issues that need to be claim paid. But you're paying for the actual cost of the claims. So in that, you're creating some savings. So back to why these two areas that you can influence matter. It's important for you to ask yourself the following questions. Do you have, as an employer, the tools in place to help guide your employees to lower cost, high quality care? It's pretty scary if you look at data of, and I'm not going to throw anyone under the bus because it can vary, but let's say a popular hospital system that you are very familiar with and comfortable with, and you look at any specific area, say a knee scope, and you go into that area and you start pulling the data. How many readmissions does this provider or this office have? They have a big name on the front of their building. Does that mean that they're always going to be the best place to go? Well, data would show otherwise many times, right? There's going to be a brand recognition and people will go there, but perhaps the quality isn't as high as you think. So the fact that you're going there, there's a higher chance that you're going to get readmitted because it didn't get done right the first time. It may be the most expensive option, and there may be another equally recognizable brand name hospital next door that has a much lower cost. Unfortunately, in healthcare, we are not privy to that like we are in any other consumer area. But there are ways that we can gather that data. Okay, there are groups that focus specifically on providing this, so that if you're the one that's having to get a knee scope, you can go to them and you can say, where do I go to get the best quality and the lower cost? Okay, so do you have that in place? If you don't, I say there's a lot of dollars that are being maybe lost in that mix. As I mentioned earlier, alternative funding. Have you considered Blue Cross United, Cigna, or NM to do everything? There's a ton of fat in that process that could be carved out, and those are dollars that would come back to the employer. So something to think about. This is something that I think you guys have heard about, not just in health care, but pretty much in anything. Data is what drives decisions, or at least it should. Do you have the data and the insights to know, for example, what your network rebate is? Right? That may mean nothing to you. But if I say to you, and I'll give you this example, and I've used this before, so some of you may have heard this. A couple at a hospital, they're delivering their baby, okay? The hospital, within their fees and everything, provides diapers for the newborn, okay? That diaper, because this person was somebody that liked to drill down into the details, came to find out later that diaper, one diaper alone, was $50. That was the charge that was included in the overall claim. Now, the claim was thousands of dollars, and nobody goes through, and nor do they have the data to be able to drill down to that granular of a level. But this person did, because of the plan that they were on and the way that it was set up. So they were able to find out this diaper was $50. Now, had that person taken the elevator, gone downstairs, onto the lobby, to the store that they have, the convenience store that they have at the hospital, and picked up a pack of diapers, he could have bought a 30 pack for about $15. Okay, but one diaper was $50 on the 5th floor. Okay, the fact that you have health insurance and they're covering that doesn't necessarily mean that you're better off paying for the $50 diaper upstairs than you are paying for something that may be a lot cheaper. So how do you know what the insurance carrier is paying the provider and what that rebate is? Because if the starting point is $50 for a diaper, then I don't necessarily want 50% off of that, nor am I going to feel good about having 50% off. I'm not going to have warm fuzzies that I'm getting 50% by having Blue Cross, UHC, Cigna, Aetna when the initial price is so ballooned, right? So how do you get data into that? Well, there's ways in the market that you could do that. And I would recommend that if you have a trusted advisor that you work with, that you have those type of conversations when you meet with them. Hey, is there a way that I can drill into this data? What does that take? Are there alternative funding methods that I can look at so that I'm not just spending a ton of money and renewing every time at 15 to 20% higher, and now with this balloon coming in even higher than that. So to wrap up, this here is a slide that we use often with our own clients, and it's a funding spectrum. So this will show you more than you need to know, really, and don't let it overwhelm you. But this here really shows the alternatives that are available to companies of different sizes, right? Depending on the size, on the complexity of the plan and the manpower within the organization, this is the kind of slide that I'm spending a lot of time talking to my clients about, okay? Where do we need to land? What do we need to look at? Where do we have the risk and the cash flow even to consider going into? I start a few spots here just because I thought of the possible pool of people that we would have today and what may be something that you would want to have a conversation with your trusted advisor about. So I mentioned what fully insured was. That's going to be at the very top over there. And that's going to be what you are looking at if you're paying UHC, Cigna, and premiums and doing nothing else, okay? By far the most expensive model, not necessarily the wrong model for you. It may be the best model for you at this moment, but just know it's the most expensive. As you move down, there's something called level funded, where you're beginning to dip your toe into self-funding your own claims, but you're still pretty well protected. You have set premiums every month. You're not having to pay extra if your claims blow up and you have multiple people going to the hospital. It still remains the same, so it's a good option to consider, to look at. And then you start getting to more of the self-funded options, something like a captive, which if you don't know what that is, essentially you're just pulling in with other companies to mitigate the risk of high claims, and you're kind of using one another to help fund that. So there's an extra layer of protection within a captive, but technically you're self-funding at that point. You're funding your own claims. And then there's partially self-funded, which just means you are telling the carrier, I no longer want to hire you for everything. I am going to become my own insurance carrier. I am going to pay for my claims, and I'm going to rent out your network and your management, so your admin fees and all of that will still be in effect because they're still going to be sending out ID cards. Your people will still have the big insurance name on their ID card, but technically you are the one that is funding the claims. You're playing the part of the insurance company, which obviously gives you a lot of room to move about. There's a reason why when you start funding your own claims, you see that there's a lot of additional funds that you can begin to redirect back to your own pockets as an employer. Okay, hopefully I haven't bored you enough. So we will jump into a couple of questions here, okay? Now, since we have a virtual audience and we have an in-person audience, I have a question for each, okay? $25 Starbucks gift card, and we'll start with, let's go with online. Why don't we do online, okay? So for all of you that are on Zoom, how many months will it take for providers, remember providers are hospital systems, doctors and such, to work through the surgical backlog caused by the 2-month shutdown? How many months will that take? And Andrew's going to be watching that chat, and whoever answers first wins the prize.
Somebody answered 120.
20?
Or 120, but I don't know if they meant 20.
120 is not correct. Let's hope not, at least. Let's hope it's not 120 months, but it is close.
Oh, we have somebody say 20.
Ding, 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 20 months. Okay, now the one that said 120, hopefully they're not right, but you never know. It could take longer than 20 months. Okay, good job, good job. So we'll get your information and we'll have a virtual gift card sent to you. Okay, for the folks in the room, and on this one is gonna be hand up in the air. That's how I'm gonna know who did it first. Okay. What two areas of insurance what two areas of insurance,
What one area now?
what one area of insurance can employers impact?
Unit cost utilization.
Ding, ding, ding. Okay, I'll give you half the gift card.
Yeah,
I'll give you half the answer.
I don't deserve half.
Well, yeah, there you go. Yeah, I helped them out. See, we had it all planned out. All right, guys. Well, I hope that was helpful to you. I'm going to hand it off to Luke now, who's going to be talking about the commercial side of insurance, which is going to be very interesting to listen to. So, Luke.
Hi. Thank you, Sebastian. As you mentioned, I'm going to be talking about property and casualty on the commercial side. So Sebastian just got through talking about employee benefits. The other pillar, property and casualty, which most folks are relatively familiar with. To dive in here, looking backward at 2020, unprecedented year for that term a lot. But in terms of how that affected our property and casualty markets, and more importantly, our small businesses and our employers on a day-to-day basis, we had an influx of business income claims. So when there was the nationwide shutdown, local shutdown, a lot of companies looked to their insurance companies saying, well, we can't generate revenues. So how do we continue to stay in business? There's a line item in insurance on the property side called business income insurance. And that is typically prepared or put in place in order to cover a company if there is a covered cause of loss that renders the business unable to operate. So pandemic, unfortunately, was not included on the vast majority of policies. So a lot of those the vast majority of those business income claims were denied outright. The fallout from that, we had a lot of class action litigation, specifically on the retail, restaurant, and hospitality industries. Some notable names, not only in the United States, but also in the UK. Those are ongoing. Going forward, noticing on your current property policy, there's likely a pandemic exclusion. So a pandemic going forward, either it's to be covered or excluded, and in most cases, it is excluded. So looking backward at what we did in the moment last year to help our small businesses and our middle market clients continue to deal with the pandemic, were how do we build liquidity and conserve capital quickly? What we did, attempted to do with the vast majority of our clients, were to adjust our exposure basis midterm. For those of you who aren't familiar with, a lot of your liability policies, lines of coverage are rated or are charged by a rating factor of revenues or gross sales. And so with the pandemic causing a shutdown, your business is not able to operate, well, your revenues are either going to be non-existent or going to be reduced drastically. In that case, we advocated for our clients for a reduction in premium based on those models. And then we're successful in the vast majority of those. And those came in either a form of a credit or an outright refund to the client as a way to conserve capital and to glean some of that money back that you would pay for those premiums. Additionally, reducing business income limits. So if your business traditionally put out 5 million or so in business income, well, if you're not able to operate for some part of that year, obviously those numbers are going to be impacted. And so reducing those accordingly, again, the overall goal, to glean a refund or a credit going forward, increase liquidity in that sense. Unlike an employee benefit side, which Sebastian touched on, where carriers were softer in their renewal rate increases due to lower utilization, that unfortunately was not the case with our property and casualty markets. Property, general liability, umbrella liability rates continue to rise for a number of different reasons. Most easily explained via macro loss ratios. So your large carriers, your Travelers, your Hartfords, your Chubb, they have a massive book of business globally. And so when they experience natural disasters on the property side, for example, wildfires, flooding, hurricanes, et cetera, they've got to balance that some way. And unfortunately, how that typically comes across is rate increases to our clients. So a pass through. On the GL and umbrella side, litigation costs and then the frequency and severity of those claims and those settlements are what driving, or it's what is driving those rates up. That continues to be the case today. Another result of our pandemic from last year was carriers that are re-underwriting risks in businesses that they hadn't re-underwritten in many years. And so what does that look like? Well, more stringent underwriting guidelines where a company might have been able to get away with, or a carrier was comfortable with a certain level of risk transfer or risk controls in place. Now the carrier is demanding that a certain standard of risk controls, et cetera, be put in place in order to be able to offer the coverage in a competitive fashion. Practically, considering timelines, the pandemic slowed down turnaround times with underwriters. So at the other side of that computer or that phone, there's obviously a human who's typically underwriting certain risks. And with most folks either transitioning to work from home, either temporary or potentially permanently, we're seeing a pretty long turnaround time in those cases, or increased turnaround time. So planning for that timeline-wise when you're approaching the renewal date is key in order to keep things from coming out to the last minute, helping to ensure best terms and best pricing. Okay, so now to the practical side of this, I think with the tips for maximizing the company's position in terms of rate, terms and pricing. So identifying first and foremost your company's personal risk tolerance. So what that means is holistically looking at your company and determining what areas of exposure you're feeling more risk averse versus more risk tolerant. So, and that's a subjective answer. Every company is different when it comes to how they value determine risk in terms of importance. The way that your broker and your agent can help you is by determining what other folks and other companies in your sector and in your industry are doing. Competitors, for example, what limits, what deductibles they carry from a benchmarking perspective. And that helps build out a framework from with which you can determine, am I more risk averse or am I more risk tolerant in terms of my competitors and in terms of my colleagues on the side. Next, I would say determining best practices in terms of risk controls. That's going to be key when we're talking about garnering as much credit from the carriers as possible. So, for example, if you've got an HVAC contractor who's got 24 vans or work vehicles, and they've got a couple drivers operating those vans that have had some motor vehicle issues. At renewal time, carrier comes by or comes through and tries to slap a substantial rate increase on the commercial auto line, for example. One way to circumvent that or to mitigate some of that rate increase is to come up with a best-in-class plan. Well, we don't have a plan. Well, let's come up with one. And what does that look like? It can be something as simple as downloading a telematic to each driver's phone that tracks not only miles driven, acceleration, deceleration, et cetera, but also having something put into your employee handbook that you have each driver sign that acknowledges that they won't text and drive, that they'll only operate hands-free devices, essentially that they'll adhere to all local and national traffic laws. Those types of small steps, they seem obvious, but they have an aggregate effect in a positive way when we're trying to negotiate credits for an insured in dealing with carriers. Collaborate with your agent and also your carrier. A lot of companies look at the relationship between them as a company and the carrier as more adversarial. And what we try to push is and to make clear to our clients is that this needs to be a collaborative process if best results are to be achieved. So putting yourself on the same side of the table as the carrier, asking, what can we do to help improve our terms? What can we do to help improve our pricing? And in most cases, we get a really great result because carriers feel like they're more a part of the process, that they're being included, they're not being brushed over, and that, frankly, no one's hiding anything. It's built a unified front, as I mentioned, top down, and this helps to ensure best results. Next, I'd say engaging in contractual risk transfer. And what I mean by that is when you have a contract with a vendor or with someone in your supply chain downstream, requiring that they include you as an additional insured on their policy, waiver of subrogation in favor of you, as well as in other indemnification provisions. That keeps you protected if there's a lawsuit or a claim ever made against someone in that capacity, and you as a company be dragged in by no fault of your own. Those kind of contractual risk transfers are what are becoming more and more important to carriers, and by proving that you have those in place, it gives us a great level set and gains confidence with that carrier, with those carriers. Ultimately, positioning your best foot forward in terms of risk control, contractual risk transfer, and overall a collaborative environment, not only with your broker, but with the carrier, are really ways to ensure that you're positioning your company and setting that pricing floor, which is ultimately what most companies are concerned with, as low as possible, because as insurance rates continue to rise, setting that pricing floor as low as possible becomes more and more important. Okay, so keeping pace, here we are in 2021. Hopefully, we're on the tail end of this pandemic. What does that look like in terms of evolving risk in today's culture, in today's society? Well, you can't turn on the TV or open the newspaper without seeing just about every week another cyber breach. A number of different companies. I believe most recently, I won't say most recently, there was the Microsoft Exchange data breach, which impacted many millions of people and many thousands of companies. Cyber liability and ransomware is becoming by far the most vulnerable area of exposure for a lot of companies, specifically small and middle market companies, who have never really before had to think about, well, how do we protect not only our physical assets, but also our data and the data of our clients and our important records? And what happens if a breach does occur? And we've got a bad actor or a group of bad actors holding that information hostage. Well, hopefully there's a cyber liability program in place that will respond. Shifting employees to a work from home environment last year certainly was a catalyst for cybercrime. A lot of bad actors looked at this opportunity, whereas you had one office in the past where your employees would go every morning, sit down at their desk and get to work. Transitioning about 100 employees, well, now you have 100 different potential locations, 100 different offices that were potential targets. And if your risk controls weren't in place from a network security standpoint, they're sitting ducks. And even those companies, as I mentioned, the big boys, the Fortune 100 companies, McDonald's, a few years ago was Experian, a credit monitoring service, for goodness sake. And these are companies that, if they can't keep their networks free of breaches, we as middle market and small businesses supposed to do. Well, putting in place systems that ensure that we as a company are covering down on our evolving risk here in the cyber industry. Unsecure networks, remote desktop portals, single source login. That's what we're seeing is a lot of ways that these bad actors are breaching systems and that cyber events are occurring. So partnering as a solution, partnering with a cyber carrier that not only applies the coverage to the company, but also can help educate the company on what's going on out there. What is to date in real time? What are our biggest threats? And more importantly, how do we mitigate those? Partnering with a carrier not only that offers that information, but also has value add services in place that help to mitigate those. So, for example, we've got cyber carriers these days that are offering for all of their clients, once a day, they will do a scan of that company's network to identify potential vulnerabilities. And if there is a vulnerability identified, that is routed to that IT manager or that CISO or whomever is in charge for that company in terms of protecting that company's from a cyber aspect. So partnering with a carrier and maximizing the value add that they provide is key. And it's great to see that the carriers are evolving and are trying to outdo one another in terms of value add, because we as the client and we as the business, as the consumer, ultimately benefit. Another area outside of cyber liability, we're seeing an uptick in claims, not only frequency and severity of claims, are the employment practices liability. So employment practices liability, an example of a claim would be harassment, sexual or otherwise, discrimination, whether that's based on gender, religious, etc., racial, failure to promote for any one of those reasons. There's a whole litany of potential lawsuits that can come your way that will ultimately flow back to the employment practices bucket. So making sure that if you haven't put in place an employment practices liability policy in the past, well, at least you understand that that's where we're seeing on the broker side and also on the carrier side, an uptick in frequency and severity. So making sure that you've got a robust employment practices liability limit in place, but also at a deductible level that makes sense for your company. So, and then of course, periodically bring it more back to brick and mortar, just your physical assets, your property. As we know, as most folks know, materials and labor costs have risen drastically over the past 18 months. And for some materials, that's plateaued off, which is great to see. But revisiting what once used to be $1 million building might be $1.25 million or $1.5 million building. So if it's been a while since you've revisited those replacement cost limits for your physical assets, it's important to do so. Not only for the practical piece, but also for co-insurance reasons. We can dive into co-insurance. It's more of a lengthy discussion. Okay, so just to wrap up here, got a couple questions, one for our in-person and one for our online. I'll start with our online. Andrea, do you want to let me know who responds to this first? Give me an example of a risk transfer, contractual or otherwise, that can be implemented between you as a company and either your vendor or someone in your supply chain.
No, answer is yes.
So a contractual risk transfer measure.
Nobody yet.
I'll give you the first one. Or the second one, I should say. Waiver of subrogation. Okay, additional insured, that's right. That's the most common that we see, requiring again that you are transferring that risk for any vendor or supply chain member on their policy that they include you and your company as an additional insured. Second question for our in-person folks is going to be, other than cyber liability, what other areas particularly do we need to pay attention to in terms of lines of coverage in today's market? Gerard?
Employee harassment.
Employee harassment, okay. Employee practices liability, we'll take that, absolutely. Employee harassment is an example of one of those claims. Well done. Anyway, that's all I have. If you have any other questions or wanted to discuss any one of these points more offline, you know how to reach me. Thank you.
So we do have one question in the chat, and if anybody has a question here, I'll hand you guys the mic. This question came through when Sebastian was doing his presentation. The question is, who is a source for competitive healthcare services?
Who is a source for the competitive healthcare services? Okay, I want to make sure I understand the question correctly. So when you're looking at all of the different options that your employees have available to go to the doctor, hospital, an urgent care facility, all of that, they're going to be third-party groups that focus specifically on gathering that data and being able to provide it in a way that your employees can access it, okay? I highly recommend that that is something that you have in place, especially as you begin to take some of the risk of funding your own claims, but even before then. So essentially, and I can send a list of some of the different companies that do this, but what they'll do is they have years and years and years of data that they've gathered from, take our Dallas Metroplex and our networks. So they know, hey, if you go to Baylor for this, they are phenomenal at this location for knee scopes, just highly rated. The best performers are in this practice and their prices are really competitive. You know, I'm not going to use another name because I'm just giving examples, but let's just say another one over here, not so much, right? And so as an employee of a company that has just an ID card in my wallet, I don't know, you know, one from the other. It doesn't look any different from the outside of the building to me. So being able to access this, usually the way it looks is I would either call or email or have some kind of mobile app that I can access where I say, I am looking for a knee scope in the next 30 to 60 days. Here's my zip code. They would actually go through the back log and provide me the data of the highest performing folks for the best cost, and then give me that information. So, and even schedule the appointment for me many times. So as an employee, it's a benefit for me. It feels very concierge-like. And for my employer, well, now they're saving, you know, $5,000 from going to this person, and hoping that the chance for readmission is lower. So, but yeah, there's a list of different providers that do this, and I can certainly send that out in an email or have a conversation with anybody if they're reference.
Anybody here have any questions?
So I don't know if you heard of this or not, but there's, I guess, doctors in some other states that are kind of building their own insurance or their own, I guess, company, so to say. So it gives the people who need insurance direct access to them, so they don't have to go and negotiate, say, here's our prices, this is what we do. And typically, it's lower than going through an insurance company. Have you heard of that? And if so, what are your thoughts on that?
Sure. Yeah, no, absolutely. That is becoming more and more of a thing. A lot of the times that is, it's membership based. So you're essentially paying a membership fee to be a part of either one or a couple of different providers. And it really kind of goes back to the old days where, you know, you had more house calls and you call your doctor and they can come visit you, as opposed to the way that the healthcare system looks today. So yeah, absolutely. There's a lot of that, which should tell us something, that even physicians and physician groups are saying, this healthcare system is just not working for me, right? As a user, sometimes I feel that way, like it's not working in my favor, but even the doctors sometimes feel that way. So that is becoming more of a thing. A couple of things to consider is if you do pay for premiums to your employer plan health insurance, just know that many times those are not going to match, right? So the employer health plan will not pay for that. So if you pay for a membership to be part of a physician group so that you can have that access, they won't take insurance. You pay them directly. So it's got pros and it's got cons, but absolutely it's another sign that there are issues with the system that need to be addressed. So yeah, good question. Anyone else have a question for Luke?
I promise I'm not a plant, Luke. Could you comment just on the snowmageddon, kind of what we encountered here in Texas and how that impacted insurance rates or just
Certainly.
kind of overall?
Certainly. That was again, unprecedented freeze. It caught a lot of people unawares. And actually put the spotlight back on construction. Wrapping pipes is now, I believe, going to be something that is done more. It's as simple as putting foam. How it affected practically, huge influx of claims, as you can imagine, not only personal line side, so for homeowners, but also commercial buildings as well. The fallout from that, more claims are paid. The carriers have to balance their books somehow, so rates have gone up. It's tough to pin the rate increase on one event or one aspect. But that's been an excuse for carriers to increase rates on the property side. Good question.
Got a question for Lou too. So looking at terms and conditions on contracts in detail. First of all, my supply chain won't accept me to put, or force them to put me on the insurance policies. They just won't do it. But the thought is, looking at through the lens of the underwriter for a minute, what if Northrop Grumman or Lockheed forced me as a supplier and on my insurance? All of a sudden, my insurance provider is looking at that and saying the risk is increased now. I would think that would be seriously frowned upon by just invoking, insurance policies, spreading it across the supply chain. Your comment on that?
The comment on that would be, there are two ways to schedule additional insurance. A common way is additional insurance as required by a written contract, which is a catch-all. Essentially, that doesn't require a company to schedule out each and every vendor or member of their supply chain and list them specifically on the policy. So by requiring that as required by written contract, as long as it's in that written contract, typically you're going to have coverage. Now, to your question, Mr. King, as to how underwriters do view that, it is something that is considered, especially when we're talking about reverse flow. So, essentially, you having the leverage in the supply chain pushing down versus someone higher in that chain pushing down. You being very intentional with how that is scheduled. So, getting with the underwriter and saying, we need to include, for example, Northrop Grumman on this contract as an additional insurer, on this policy as an additional insurer, but only within these parameters. So not for every business operation of Northrop Grumman, but really boxing in on what contract, for what component, for what product are we specifically talking about within that contract. So by minimizing the exposure in terms of scope of work or scope of what we're actually talking about, ensuring Northrop or adding them on contractually, minimizing or boxing them as much as possible. Does that answer your question?
Any more questions?
So along those same lines, I guess the large client is pushed down saying that you got to put in your insurance or anything that identify.
Indemnification.
Thank you. So when they do that, and the smaller business says, okay, I can do that with insurance, they say, well, this is not good, we have to raise your insurance. What happens in the event where the business doesn't go to you and say, this is what the large company wants to do? How does that affect the relationship, the cost, and what have you?
Well, if that's a requirement by contract and the client doesn't come to us or to the carrier to let us know that we need to do that, that wouldn't be they wouldn't be included. Does that answer your question?
I would always suggest, what I do in that case is you can negotiate the terms and conditions, and they're typically happy with the umbrella policy that a small company has based on the risk of the liability being covered. So, if they ask for 50 million, that's sort of the boilerplate, or maybe even 100 million, because they're dealing with the big companies in the world. If you're a smaller company, you can negotiate that down to your umbrella that's appropriate. should have a number on it that is appropriate to cover your business. Assuming you do, I've had no problems negotiating that number and modifying the terms and conditions on any contract.
That's right. So getting your terms and conditions, your T's and C's to a place where, okay, what is your role as that contractor within that supply chain? Limiting again, taking a look at, well, what piece are you providing to this puzzle? Worst case scenario, what does that look like? And modifying or adapting your limits on the umbrella side or otherwise.
I think that covers all of our questions. We do have a message in the chat that they would like that list from the question.
Sure thing.
That answers our question. Thank you.
Thank you all for having us.
Yes, thank you.
Just a few reminders here for everybody. Again, thank you to our speakers. Thank you to Luke and Sebastian for giving us that presentation. Thank you again to our partners, Cybersecurity Bank, for helping us. Just being a great partner with this event. A few reminders, on Thursday, August 19th, we'll be hosting Direct Connect. It will be in the same room. If you guys want to do our fast-paced networking event. On Monday, August 30th, we will feature Dr. Ricardo Lopez from GISD in our Spark Luncheon. So if you'd like to join us for that, that will also be here. That will also be over lunch. So if you guys are interested in that, you guys can go to our website for more information. There is no August Bold event, but as our speakers mentioned, cybersecurity, our next event will be on September 28th, and it will actually be about cybersecurity. So if you guys are interested in that, join us, as Cybersecurity Month is in October, so that's in preparation for your business in cybersecurity. Again, like I said, more information is on our website, that's garlandchamber.com. But this concludes our event. Everybody have a great day, and thank you for joining us. Thank you, online people.